Hey there, Yuri here from crypto tax platform Divly. Tax season is here in the UK, so if you're looking to declare your crypto taxes to the HMRC, this video is for you. You can see below for the timeline of the video if you want to skip ahead to a specific section. We'll be covering all the following topics. So the tax deadlines you need to be aware of, which taxes apply to cryptocurrency, so whether that's capital gains tax or whether that's income tax, what the tax rates are you have to be aware of, whether the HMRC can find out about your crypto taxes, whether there are any penalties for non-declaration, how to calculate your taxes on sales or trades, and then we'll go into specific transaction types. So that would be buying crypto, holding crypto, transferring crypto between your own wallets, selling crypto, trading crypto with another cryptocurrency, whether stablecoins are taxed, when you purchase a good or service of crypto, getting paid a salary in crypto, mining crypto, staking crypto, airdrops, and eventually also giving gifts in cryptocurrencies. So we'll start out with the tax deadlines. So it's important to be aware of that you need to declare all of your crypto transactions between April 6th, 2022 and April 5th, 2023. Now, if you're watching this at a later date, just be aware of the month and day there. There are two deadlines to be aware of. So one is the paper filing, which happened on October 31st. So you might be a little bit late with that one because this video is not out by October 31st. But if you're filing your taxes online, you have until midnight on January 31st, 2024 to do your declaration. Regardless of which method you've chosen, you also need to pay your taxes by midnight, January 31st of 2024. Now we're going to go into how cryptocurrencies are taxed in the UK. So cryptocurrencies are subject to taxation in the UK under two main categories, capital gains tax and income tax. So you really need to be aware of which transactions fall under capital gains tax, which fall under income tax, and which are not taxed at all. We're going to go over first a quick list of these currencies. We're going to go over each transaction type in more detail later on. But for capital gains tax, what applies is selling cryptocurrency for fiat currency, such as pounds, US dollars, or euros. That's a taxable transaction. You're also taxed when you trade cryptocurrencies between each other. So if you're selling your Bitcoin for Ethereum, that's a taxable transaction. Some people might not be quite aware of that. But just because you aren't selling your crypto for pounds doesn't mean it's not a taxable sale. So if you sell one cryptocurrency for another, you will be taxed. Also be aware that this means that you're taxed even before you send anything to your bank account. You can do all your transactions on your crypto platform of choice, and you can still have to pay taxes on those transactions. Don't worry, again, guys, we'll go over this a bit more detail later on in the guide. Now, another capital gain transaction is when you use your crypto to purchase a good or service that is taxed. Gifting crypto in a lot of instances will also be taxed. You can scroll ahead to later in this video if you want to know a little bit more about that. Finally, an interesting one that you might not be aware of is that lending crypto to stake on a DeFi platform is currently also subject to capital gains tax. And we'll go into a bit more detail about that later in the guide as well. Now, some transactions subject to income tax are when you receive crypto from mining, from staking, airdrops in some situations, and income received from a salary. Now, you won't be taxed on the following transactions, so that's very good news. When you buy crypto, that's not a taxable transaction. When you hold crypto, that's not taxed. Transferring crypto between your own wallets is not a taxable transaction unless you pay a fee on the transfer. Donating crypto is not taxed, and gifting crypto to your spouse or civil partner is not a taxable transaction. Now, what is the tax rate on cryptocurrencies in the UK? So for capital gains transactions, you first need to be aware of there's a tax-free allowance. So for any gains below £12,300, you will not be taxed. This amount, however, will be lowered to £6,000 for the 23-24 tax year. Now, for any gains above the personal allowance or the tax-free allowance, you have to pay a 10 or 20% tax rate depending on the amount of other income, taxable income you have. Now, for income tax, there's also a tax-free allowance. The first £12,570 are untaxed. If you earn up to £50,000, the tax rate is 20%, up to £150,000, it's 40%, and above this amount, it's 45%. Now, how do you calculate your gain or loss on a crypto transaction? This can be quite difficult, especially if you made hundreds of transactions, but there are tools available to you that can make this process easier, such as tools like Divly. Alternatively, you can have a really nice setup on Excel, or you can reach out to a tax lawyer to help you with your crypto transactions. But this information can be handy to know for everyone. So we'll start with the easy part. you are taxed on your gains. So to calculate your gain on a sale, you have to subtract the acquisition price from the sale price. This is handy to know that you can also deduct any fees from your sale price. So say you've purchased one Ethereum for £1,000 and you then sell it for £2,000 with a £100 fee. Then you can subtract the £1,000 acquisition cost and the £100 fee from the $2,000 sale price, and you end up with a £900 profit. Now the difficulty is finding out which cryptocurrency you are selling. You may have bought ETH on multiple occasions. Maybe you make, for example, the following transactions. You buy one ETH for £500, you buy another ETH for £1,000. How do you now know which one you are selling when you're selling your Ethereum? The solution is to pool your purchase prices together. So instead of saying your holdings are one ETH that was purchased for £500 and another ETH that was purchased for £1,000, instead your holdings are essentially two Ethereum purchased for £1,500. And each ETH in the pool is worth half of that, £750. So now if you sell one Ethereum, then you know in your pool remains one Ethereum purchased for £750. Now, because you aren't just buying everything first and then selling in that order, you have to constantly keep track of the value in your pool. Say that after these transactions, after the first purchase of ETH and the second purchase of ETH and then the sale, I then make another purchase of ETH. So currently in my Ethereum pool, I have one Ethereum for £750. I then buy another Ethereum for £250. Then now my holdings in that pool are two Ethereum purchased for £1,000. So you just got to constantly update this as you're buying and selling Ethereum. And you do this for every currency. Every currency has its own pool, except, for example, with NFTs, which you are able to identify exactly which asset you are selling. And so you have to use that exact purchase price. Now that is really just the basics. There's a lot more behind your crypto tax calculations, especially if you're buying and selling often. This is because in the UK, there's something called the same day rule. And the same day rule exists to prevent you from realizing loss by selling and then rebuying the same currency without actually changing your portfolio at all. With the same day rule, you first have to group all your sales of a specific currency on the same day together and all the buys of a specific currency on one day together. So if you make multiple purchases of ETH on one day and multiple sales of ETH on one day, then essentially it's one big purchase of ETH and one big sell of ETH. Then what you do is you first match the sell on the day to any purchases of that currency that happen on the same day. Okay, so to make that a bit simpler, I'm going to show an example. But we also have more examples in our tax guide, which you can read. And we'll also link in that tax guide to the HMRC's website, where they provide a lot more examples as well. But so the same day rule example. Anna has originally purchased 10,000 Cardano for £10,000. Now, the value of the Cardano has dropped to £6,000, and she's hoping to realize a loss of £4,000 by selling her Cardano. Now, she makes a couple transactions, and she essentially does not end up with the £4,000 loss she expects. So see if you can spot what mistake she has made. So originally, she purchases 10,000 Cardano for £10,000, each Cardano worth £1. She then sells 10,000 Cardano for £6,000, and on the very same day, buys back 5,000 Cardano for £3,000. So Anna's goal here, realized £4,000 loss on the sale of 10,000 Cardano, the difference between her sale price and her purchase price. However, the calculation isn't quite right. So because she has rebought 5,000 Cardano, this has to be matched with her sell of 10,000 Cardano on the same day. So the first 5,000 Cardano sold are matched with the 5,000 Cardano bought. Now these 5,000 Cardano were sold for £3,000, half of the total 6,000 purchase price. Now, because we have to match it with the purchase on the same day for also £3,000, there's no gain or loss on the sell of the first 5,000 Cardano sold. The second 5,000 Cardano comes from the original 10,000 bought, and they are sold for £3,000 and were originally acquired for £5,000, half of the original purchase cost. So essentially, she makes a loss on this transaction of only £2,000, because on half of the transaction, she makes a loss of £2,000, and on the other half, she makes no gain or loss at all. What remains in her portfolio after this day is 5,000 Cardano with a purchase cost of £5,000. So overall, instead of a loss of £4,000, she's left with a loss of £2,000. And I can understand this can get a little bit complex, I think. So you might have to rewatch that or read our tax guide. But it does get I wish I could say it gets a little better, but it gets a little worse. Because there's also the bed and breakfast rule, which is a very similar thing to the same day rule, but it's about selling and rebuying the same currencies within a 30-day period. So after applying the same day rule, if you have any repurchases in 30-day period, you would match these to the sales that occurred. So say if Anna, after her initial repurchase of 5,000 Cardano, buys another 5,000 Cardano the next day, then the entirety of the 10,000 Cardano she sold will be matched with those purchases. Essentially, even though she believes she's entitled to a £4,000 loss, it's even possible that she ends up making a gain. So if you're not careful, you can make a gain when you are actually expecting to make a loss here. For more examples, again, you can check our tax guide. It's on our website, and in this website, we will also link to the HMRC guide, which provides a couple more examples. There's one more quite difficult thing that I have not yet mentioned, which is regarding fees in a crypto-to-crypto trade. So usually, if you purchase crypto for pounds, you can add the fee to the acquisition cost of the cryptocurrency. So say I spend £1,000 to buy Ethereum, and there's an additional £100 fee, then that Ethereum was now acquired for £1,100. Likewise, if I sell crypto for fiat, and there's a fee involved, I can deduct that from the sale price as well. So say I sell my Ethereum for £2,000, and there's a £100 fee involved, then I can deduct that from the sale price, and it's now £1,900. However, the problem occurs if there's a crypto-to-crypto trade. You can use the fee for both the sell of a cryptocurrency as well as the purchase of a cryptocurrency. So when they both occur in the same transaction, it's a little difficult to know where you can allocate the fee, because you cannot add it to the purchase price and deduct it from the sale price at the same time. You cannot benefit from it twice. Essentially, what the HMRC recommends is that you add 50% of the fee value to the purchase price of the cryptocurrency you are acquiring, and subtract 50% of the fee value from the sale price of the cryptocurrency that you are selling. Now, if you are using Divly for your taxes, then Divly will automatically do this for you. But it's important to keep in mind that you have to come up with a fair allocation of the fee when you're making a crypto-to-crypto trade. Can the HMRC find out about your crypto transactions? There's multiple ways in which they can go about doing this. The first is that blockchain technology allows for a public ledger of your crypto transactions. So all your transactions on the blockchain are public information, and there are companies out there that analyze those transactions. There's a company, for example, called Chainalysis, which works with governments to help track your transactions and make sure that the taxes being paid on those. And potentially they also help find fraud committed with crypto. Now, there are also other ways in that the tax authorities can find out about your crypto transactions. For example, if you have a deposit to your bank account where it's not clear where it's coming from, there might be some questions involved, for example. Alternatively, really the big one is that the HMRC works with crypto exchanges to help track the people who need to pay taxes. For example, Coinbase UK has publicly stated that they turn over transaction details for users who receive more than £5,000 worth of crypto into their Coinbase account during the year. And this is an ongoing collaboration. Are there penalties for late declarations or not declaring crypto to the HMRC? Yes. If you miss the deadline for filing your taxes, you can pay a fine of a minimum £100 up to 3 months late. But the longer the delay, the higher the penalty will go. You may also be fined if you are late with payments for your taxes. And there's also penalties for errors in your tax declaration. However, if you've taken reasonable care in preparing your tax return, you may not face a penalty. What constitutes reasonable care can vary, but it generally means that you've made a genuine effort to accurately report your financial situation. If you believe you have a reasonable excuse for late filing or payment, you can appeal the penalty, and you won't have to pay until a resolution is reached. The HMRC also provides a tool to help you estimate your penalty size, so that can be handy to look at. Again, we have a link in our crypto tax guide you can find on our website to the HMRC's information on penalties and appeals, as well as their tool to help you estimate your penalty size. So we've already gone over that sells and crypto-to-crypto trades are taxed. You can deduct your acquisition costs and your fees from the sale price to get your gain or loss. Now, interestingly, regarding gain or losses, you can net them. So because you have to pay taxes over £12,300 of capital gains, If you have a cryptocurrency that is currently at a lower value, you may want to consider selling it so that you can lower your net gain to be below £12,300, and so that you won't have to pay taxes anymore on capital gains. Then we're going to cover mining income. If you receive cryptocurrency, you have to report this in your self-assessment tax return under other taxable income. Your mining income falls under this. You are required to report your income unless you receive less than £1,000 in miscellaneous income in a year. So it is possible that you won't have to pay taxes on mining income in some situations. The value you have to declare is the value of the crypto assets at the time you receive access to them. And this amount will then be subject to income tax. Any future disposal means you have to pay capital gains tax on your mining income. However, you can deduct the amount you already reported for your income tax from this gain, so that you won't have to be taxed twice on your mining income in this way. Now, do be careful with mining income. You may be taxed as a business. Whether you are seen as conducting a trade or business depends on the degree of activity, the level of organization, the risk involved, and the commercialization. So you may want to reach out to the HMRC directly to ask them about your specific situation, and they'll be able to help you there. Now we're going to go into staking. We're also going to go into a little bit about DeFi platforms. So staking rewards are taxed as income when received, and any disposal of these rewards in the future can trigger capital gains tax. When you earn rewards from staking, they are subject to the tax of the value at the time you gain access to them. If you later dispose of the staking rewards, for example, sell them, you must pay capital gains tax on any increase in the value since you received them. Now we're going to go a little bit into DeFi platforms here. Currently, if you need to provide liquidity or send crypto to a DeFi platform for staking, then this is likely seen as a disposal of your assets. Consequently, you do need to pay capital gains tax on these transactions, even if you think this is just a transfer and you still have ownership of the assets. This is likely not the case, and I recommend looking into the terms of service of the platform you're using as well. So, for example, if you give up Ethereum and Tether or USDT in exchange for a liquidity token, you will be liable to pay tax on the difference between the value at the time of the disposal and the acquisition costs of the Ethereum and USDT. There are potential changes coming, so it's important to note that there has been a consultation published back in April 2023 regarding the taxation of DeFi activities, especially involving lending and staking. And the consultation suggests that changes might happen, and these kind of transactions will no longer be seen as disposals for tax purposes. However, these changes are not yet officially enacted, so the current tax rules do apply. Regarding airdrops represent a unique scenario, so they can be both taxed or untaxed, and this depends almost entirely on whether you've performed any reciprocal action to receive the airdrops. If airdrops are just being deposited in your wallet without any action, then these are not taxed. But if you're doing anything and in return you receive compensation in the form of airdrops, then this is treated as miscellaneous income. A lot of people ask whether stablecoins are taxed. And well, then we just have to look at what stablecoins really are. And stablecoins are cryptocurrencies. And a gain or loss on the disposal of a cryptocurrency is taxed and subject to capital gains tax. Even if the stablecoin is pegged to the US dollar, you might still see a gain or loss. Especially because the US dollar exchange rate to pounds can vary. So you might actually see quite large losses or gains on stablecoin transactions, even if you're expecting them to be almost zero. Is gifting crypto to a friend or family member taxable? Yes, in a lot of cases, it's seen as a disposal of your cryptocurrency, so you have to pay capital gains tax on the difference between market value and your acquisition cost. However, if you're gifting to a spouse or civil partner, this amount is entirely tax-free. Important to note is that transferring crypto between your own wallets or own accounts on exchange platforms is not a taxable transaction. You are not losing ownership of your crypto at any point. It's not taxed. However, if you pay a fee for the transfer and this fee is paid in cryptocurrency, then that fee is seen as a disposal of your cryptocurrency. So you have to pay capital gains tax on the increase in value of the fee that you spent to transfer your crypto. So if you type in divly.com in your navigation bar, you'll be taken to our crypto tax platform. We support over 20 plus countries. And if you want to see sample tax reports for the UK, you can click on view sample tax reports. Currently, we support over 150 plus wallets and exchanges. You can search here for your wallet or exchange. You can also type in the search bar, say I use Revolut. Oh, Revolut. The pricing is done on a per year basis, but we also provide a bundle. So 2011 to 2021 is all for the price of one tax year. If you want to learn more about crypto taxes in the UK, you can go to Crypto Tax Guides. So resources, Crypto Tax Guides. Click on the UK, and they have a more in-depth guide available to you here. We also provide some handy links and some examples. So that could be very nice to look at. So now let's get started. Setting up an account. So get started. We do not verify your email address, so you can really type in anything. Divly UK example divly.com is what I'm going to go for. Just type anything really. I agree to the terms and conditions. Create account. Okay, so taken to this page. So you can just click continue, then select your country. So we're going to be doing the UK. It will automatically fill in the rest. You can also change to dark mode in the platform. I like that, so I'm going to select it. Okay, and then you can start adding your wallets. So then you're taken directly to the wallets page. Now I'm going to add a sample file here. So I'm going to use Revolut. Click on Revolut. Then right here's a little box where it says the upload starts when you drop the file here. For Revolut, we only have a file import available. But if for another wallet or exchange, there's also an API available. It will be available. It will show up here. So you can click File Import. You can click API. You can click Empty Wallet if you just want to create a wallet of no transactions. But I will import a file. Okay, it usually goes pretty quickly. Yeah. Then you can go. Well, first let's calculate our taxes. Okay. Then you can go to the overview page and you can track how your portfolio is doing and your current portfolio holdings. Wallets page, you can add more wallets. You can also see more information specifically about each wallet by clicking on them. On the transactions page, you'll get an overview of your transactions. If there's any transactions that you might need to consider reviewing, say for example, we don't have price information for that currency, or it seems that you've not imported all your transactions, it'll show up here, and then they'll be provided extra information on what you can do. Then finally, we can go to the tax report page. We can select for what year we are looking to declare, and then we can create tax reports. I'm going to show you what a tax report looks like for the UK. Here we go. So there's two files that are provided to you. One provides all the information you need to declare, and one is a transaction history that includes all your capital gains computations, which you also need to provide. So the report itself first provides a quick overview. And here we go. This is what you need to declare in your form SA 108. Here's some additional stuff for derivatives, if you have used derivatives. And then we go into specific transaction types, all the information that you need to declare. Okay, that's it. I hope this guide has been helpful to you. And please stay tuned for any additional videos regarding the UK. If you do have any questions, let us know. And we'll see if we can add that to a future video.